I would now like to introduce today's presenters. Michael Jansen is Chief Research Guru at Everest Group. As co-founder of our research practice, Michael offers profound insights and analysis to enterprises and service providers alike. He is particularly well known for his ability to hypothesize clever and challenging ideas based on his fact-based insights across business and IT processes, sourcing models, and industries. Eric Simonson is managing partner of Everest Group's research division. He has more than 10 years of sourcing strategy and global services industry analysis expertise, first as a consultant and then in ongoing management of Everest Group's research practice. As partner, Karthik leads Everest Group's global sourcing practice, which includes the global location optimization practice and firms work with global in-house centers, GICs, and country associations. And with that, I'd like to turn things over to Eric. Take it away, Eric.
Great, thank you. Next slide, please. Let me just set the context for today's webinar. We have two basic topics. One, what happened last year, and then what do we think are the most important things for next year. Just to anchor everyone on where this comes from, we have a couple different sources of information for this. From a data perspective, a lot of the things we'll be providing in terms of the outsourcing deals, the GIC tracking, location data, et cetera, comes out of our Market Vista coverage. This will be supplemented by our other work that we do in our published work, but also a lot of our analysis we provide to enterprises and service providers and where we see them headed, and then our views of what all that means for the broader market. And next slide, please. The structure for today's webinar will be three basic components. First, we'll start off with a look back on what were the most interesting things we saw in the market in the previous year. As mentioned, we'll go into the trends we see that are most important to keep an eye on in this coming year. There'll be 5 of these, and they'll cut across a whole set of dimensions, and I hope to have some good discussion here amongst all the panelists. And then we'll conclude with a question and answer section. If you have questions throughout the webinar, feel free to send those in. Some of them we'll try to reply to in the middle of the webinar as we're going along. Others will hold for the end for the final Q&A session, which should be roughly 10 minutes, pending how quickly we can get through the rest of the material. With that, I'd like to hand it over to Michael to kick us off with a little question for the group.
Yeah, so let's start off the session here with getting a little bit of feedback from you. And if we'll open up the quick poll, the question we have for you to start with is, I think we all, for the most part, felt really good about 2018. And so we're 2 months into 2019, and our question to you is, how do you feel about the confidence in hitting your 2019 targets? So just a basic conversation, more confident, much more confident, neutral, less confident, or much less confident. All right, so we got a good number of votes right now. All right, we'll keep it open for another 5, 4, 3, 2, 1. All right, let's go look at the poll here. And neutral is neutral to slightly positive confidence. So I think we had a little bit of some question marks that got introduced into the system in very late 2018 with some of the tariffs and some of the other challenges we were facing with the government shutdown. But it feels like right now that people are at least as confident as they were into 2018 going into 2019. So let's use that as a backdrop and context setting for as we go into the rest of the session. All right, so the first what we're going to do is go through a series of data points here from the research. And the first thing I want to ask Karthik is, what happened in the market? What did you see?
Thanks, Michael. 2018 was a pretty interesting year. After a number of years, we saw an increase in the number of outsourcing transactions. So that's the chart that you see here up on the screen. For a number of years, I'd say at least 3 to 4 years, I've seen the number of new outsourcing transactions reduce, but then 2018 saw a significant uptick, almost 33%. The reasons behind these are broadly three reasons. One, more discretionary spend from enterprises, largely US-driven enterprises, and that was driven by greater business confidence. That resulted in an increase in the number of consulting and system integration types of deals. The second was there was a lot of pent-up demand, right, from previous years that enterprises found comfortable now to spend. If you were to take a closer look into what drove this growth, the number of BPO deals, the growth was more than IT overall. In terms of verticals, banking, financial services, and technology and communication witnessed the highest growth. What is also interesting is while the number of outsourcing transactions increased, the average of annual contract value has reduced, right? And we've removed some very large deals that could have caused an anomaly in this analysis. But if you were to look at the bulk of the deals, the average deal value has declined, and that's linked to the nature of services, largely digital based, which we will talk about in the later half of the webinar. So that is the story on outsourcing. Now, moving to the story on GIC setups. So GIC, just for the benefit of those who are joining our webinars for the first time, GIC is a terminology, stands for Global In-House Center. It's also called in the market as sometimes GCCs or shared services captives. Enterprises continue to set up GICs, and this is a continuation of what we've been seeing over the last few years. The number of new GIC setups was an all-time high in 2018. And here again, manufacturing and technology and telecom communications were the two sectors that were driving adoption. We'll talk more later in the webinar about what's driving this. So what services were being bought, primarily from an outsourcing standpoint? Eric, do you want to talk about, if you were to dive deep into the outsourcing transactions, what was the leading service or the trend that you saw in terms of outsourcing spend?
Yeah, absolutely. I think that the simple answer is digital. We started tracking in these outsourcing deals based on the scope, which portion of them are focused around digital themes and kind of next gen objectives. And it was not too many years ago that this was less than half of the deals were oriented around digital themes. We now have that nearly 70% in 2018. So not only did it gained share on an expanding market, which I think goes back to Karthik's point around more discretionary spend as well. So digital was the dominant theme in terms of the new motivation. Within that, if we look at which digital components were being included, we see a number of things that stick out being almost a third of the deals. Cloud at the basic efficiency level, just things get built on the cloud these days, and people want to modernize towards that. So that's a highly common component. Automation, this is RPA, but it's also other things as well. Trying to take out the labor, the manual work, etc. And then the final is just the overall cluster of other digital components, whether those be the Internet of Things, digital interactive, etc. These were the big drivers of that. And often it's multiple components combined. Digital needs to be composed across a whole number of elements. So that's the real driver on the outsourcing deal. The next question then is, if that's what the enterprises are buying, what are actually the service providers doing to respond to that? So kind of how aligned are their actual digital priorities? Michael, what's your take on this?
Sure, and what Karthik and Eric just showed you were the 2018 actuals, and I'm leaning forward here looking at this chart asking what the intent for 2019 is. So what are people looking at doing? So if you take the first click on this and you look in the so orientation on the slide here. On the left side you have the enterprise intent, and on the bottom there you have the intent of the service providers. So what are their top 3 investment areas? Where are they prioritizing their dollars in 2019? And so what you'll see is at the very top there, both the enterprises and service providers want to look after things like the automation RPA. So you saw that on Eric's chart just a second ago for 2018. They're looking at big data, and they're looking at cloud solutions. Those are the things that are in the uppermost importance for both sets of buyer and seller. If you take the next click down, a little bit more interest on the enterprise side for mobility, cybersecurity, and some of the advanced automation. So these become a little, if you think about everything in the upper right, those are general utility that can be used by everybody. Get a little bit more specialty in the next set there around mobility, cybersecurity. Those become more depending on what your business is. You'll pay more attention to any or all of those. And then if you take the next click down here, and I always like to point this one out here, everybody likes to talk about blockchain. And we're not necessarily saying that blockchain is not important when we see numbers like this. What we're saying is it doesn't rank in the top 3. And then my broader, more general observation is that it's much more about the ecosystem and the nature of an industry segment, and going to be led more by that ecosystem than it would be the specific technology. So I think the technology is interesting. People are curious about it, but they're being applied in a context of a specific industry or ecosystem. So anyway, so that kind of sets the stage for 2019. And then as we think about the next question here is which service provider segments are gaining the most traction? And I'll let
yeah, Mike, I'll take this one. So if we at a simple level break down the service providers into 2 clusters. On the first, I'll talk about the offshore heritage. So these are those whose primary value proposition as they were scaling was around labor arbitrage. That's diversified and become more robust over the years, but their original heritage was around labor arbitrage. And then the second category is what we call global service providers, and these are organizations you would have thought as being the incumbents 15 years ago. That the labor arbitrage model is something they've had to respond to, in some cases also lead, but was a potential disruption for them. And basically what we see is over the last bit of time, the offshore heritage providers are managing to grow about 8%, which is well down from the upper teens or even in the 20s, say 10 years ago. But that actually is quite strong compared to the traditional players. They're around just barely above 0%. Hidden underneath this for the global guys is that the asset-heavy infrastructure business is actually declining as the world moves to cloud, which we saw in the outsourcing transaction data as well. So there's kind of a drag they have of the end of the tail of a traditional business model that's now being replaced by new models and new value props. So that's sort of the separation that we've seen. If we ask then, what is that? What is really the trend there? What we've seen in the offshore players is that they've been a little bit more aggressive around inorganic growth. They've also more aggressively adopt localized talent models. So think of that as being onshore. The need for digital services has helped accelerate that, along with just a general maturation. They've also done a lot of reskilling and upskilling, particularly in India. The NASSCOM has been a big push on this, and tens and hundreds of thousands of people were being given opportunities to move into newer tech. And then a range of other things, but I'll call it in particular the last point on aggressiveness in both solutioning and risk-taking. What we hear from both the providers themselves and from their customers is that the world is largely brownfield in terms of outsourcing transactions. There's not much greenfield left. And so people are becoming much more aggressive in how they compete for existing business that's already been outsourced. That's both to capture growth, but it's also in some ways emboldened by the new digital technologies, particularly automation, that allow them to think that what they can commit to in terms of either a lower total cost, higher performance levels, faster things, higher quality, that they can do that through technology, as technology increasingly takes a bigger and bigger part of the value capture for them. So that's sort of the end of the outsourcing side. I want to now ask Karthik, so what are people actually doing on the GIC side, the internal service delivery? How's that being complemented by what we've seen in the outsourcing side of the equation?
Okay, thanks, Eric. What we're calling this the DIY approach, it stands for do it yourself. That's a trend that we've seen intensify over the past few years, with companies being a lot more comfortable with the GIC model, and in many cases even insourcing work from third-party service providers. The key message I want to convey here is that there has been increased GIC adoption by small enterprises. If you look at this chart, over close to 40% of the new GIC setups in 2018 were from enterprises that were less than $1 billion in revenue. What were the key reasons for this? There are 5 reasons why we're seeing GIC adoption spread to small and medium enterprises. If you can have the next part of the slide come up, please. First of all, there is a well-established leadership pool. That's often the most important thing to address in setting up a GIC across the key GIC locations. By that we mean India, Philippines, Poland, some other nearshore Latin American locations. There's a fairly robust services ecosystem. So everything that it takes to set up and run a GIC in terms of infrastructure, professional services firms, that's well established. More importantly, there is the confidence that small, medium enterprises have from a number of their peers, and by peers I even mean larger companies in their industries that have seen the model be successful. Again, not to forget the technology advances that have made the whole process of transition, collaboration, transfer of knowledge, very smooth. Now, the one message that I like to leave to the audience is that the concept of economies of scale has been challenged significantly. In our assessment, a GIC can be viable economically even if it is 50 to 100 FTEs. And this challenges conventional notion that you need a minimum scale of 500,000 to make it successful. Now, the reason for this is if the GIC is doing niche work, and if it is managed and governed well, and if there is a clear vision to make it an integral part of the parent's digital agenda, it is possible to make a small-scale GIC successful. In fact, we've been helping a couple of small to medium-scale niche GIC set up over the last year or so, and all of them are between 100 and 300 FTEs. So the focus now is not from scale, but really around what value can be generated through GICs. Let's move to the next question. I'm sure all of you will be asking this question on, okay, so small and medium enterprises are leading adoption, but what does the landscape look like in terms of the functions delivered by these new GICs? If you were to move to the next slide, there is a clear shift from the traditional IT and business process functions to more R&D and engineering. Right? So close to 70% of the new GICs set up in 2018 have been from R&D and engineering. And just to recap, GIC in our definition includes both offshore and nearshore locations. So a few examples of these R&D engineering GIC set up in 2018 could be Harman International in Pune, Continental that set up in Gurgaon, Microsoft that set up something in Taiwan. So we're seeing more growth in R&D engineering. The reasons for these are One, given the strategic nature of work, there is a clear preference towards the GIC model to develop in-house capabilities. Many of these services are closely aligned with the innovation agenda, where enterprises see GICs as a key pivot or a catalyst for the digital agenda. So I think we're seeing a shift, not just in terms of the nature of companies setting up GICs, but also the functions they're being set up for. And we expect this to continue in the years going forward, where the focus will shift more towards value than scale.
All right, thank you, Karthik. And as we move into the next section, heretofore we've been giving you a question and a set of data points to support that. As we move into the next section, we're going to talk about the most important trends. We'll have a discussion around each of those trends. And so as we do the setup for that on the next slide, I want to just bring back something we did a survey of our enterprise clients at the very end of last year. So these are thinking about 2019. What were your key business challenges? And quick reminder what those were. Number one challenge was a disruption in the business model. And I think this is not so much about discovery. I don't think this is about, hey, there's something radically new going to happen here that happened in 2018 that's going to impact 2019. I think most of those issues are pretty well understood and known. I think the issue around that we're facing right now is, do we have enough runway in legacy businesses? Do we have enough runway to get those changes made before we run out? And right now, I can point to the retail industry sector and the Amazon effect. It's something that's not new. I mean, we've been talking about Amazon for now well over a decade in terms of being an impactful part of the equation there. But it was just in 2017 and 2018 where we saw the real impact of store closures. So in some of our best of times, we're having some challenges there with store closures. The second one that we have on here is talent skill shortages, and the talent challenge that I've always talked to senior executives about has primarily been about getting the top talent in the organization. And so as we think about the challenge we have right now, especially in North America and Europe, it's really about an absolute shortage of skills. So true talent shortage. And while people would like to talk about how they're going to get the top talent, it's more about getting arms and legs. And the final one here that we've got is pricing cost pressures. And so I think the tariffs is always a mystery out there. Will there be more tariffs or not more tariffs? But the reality is that we're seeing extreme pressures on the labor force, with $15 an hour becoming the new minimum wage. And if you're paying attention to the news feeds from a few weeks ago, you saw that Walmart came out and said that their average truck driver is now going to make $87,500. And if you think what that does to all of the kind of the ecosystem of labor, if a truck driver can make $87,500, what does that mean to a fresh college graduate that was typically making $50,000 or $60,000? There's going to be a lot of questions and rejiggering of the system. So with that, let's move into the questions or the actual challenges. So the trend number one that we talk about is, it's kind of a catchy phrase here: near-term clarity in a disorienting environment. And I would go back to the comment I made earlier is, I think most people know what they need to do and they're busy doing that. And so let's roll to some of the discussion items here with Eric. All right. So with all that uncertainty around, I think we can look at that rising uncertainty around nationalism, the optimization around flags and countries, the financial markets. We've seen a lot of gyrations there, more so than we have recently, and then the rising prices. Eric, let's talk about the things that bring certainty to that equation.
Yeah, so I'm going to talk through these 3 points twice. Once as the concept and once with an illustration. So the broad picture we're trying to draw here is the macro environment is indeed uncertain, and Michael's touched on those on the left-hand side of the chart. There are a number of response levers that may not seem like they directly help you, but if you look at what people are doing, we think do provide some insulation. So the first is automation. Taking labor out, making things faster, more predictable. The second, analytics. If you can know something faster or sooner in a changing world, that's very valuable. Maybe a change in your customers, maybe something related to risk, supply chain, etc. And then finally, the demand for good experiences is only increasing, and so it's important to advance that because it's increasingly moving from being a differentiator to basic hygiene. So that's all those things I think are fairly commonly spoken about. Let's now illustrate this thinking about Brexit, and we'll assume Brexit happens here on March 29th. If Brexit happens and you have more rules baked into your automation of processes, or you know how to create an automation, you will have a chance to deal with some of that uncertainty and the repercussions of it more quickly. You won't have to necessarily retrain as many people as quickly as the landscape changes. If you have good analytics, you will potentially know what things are looking odd compared to previous. What might really be happening in the supply chain. We've heard a lot of scary things about potential, the food supply chain. Analytics, Internet of Things, the intersection of those can allow people, within hours and certainly days and weeks, to really know what's going on and what was hype and what was reality. And then finally, if there are some messes out there, the companies are better able to create the best experience. Either doing predictable things in their financial services, helping their customers overcome challenges. They're going to be able to differentiate. So all these things are kind of no regret moves anyway. But then when you think about the ability of how it helps you deal with change and uncertainty, they're great differentiators and must-haves. Let's now look at some further uncertainties that we really don't know about. So we talked about the uncertain environment on the earlier slide. Actually, I guess we described it as the disorienting environment. What we've just covered is some things we do know and some responses, but there actually are quite a few other things that we really don't have a great sense of how will play out. None of these will be answered in a day, a week. They're going to happen quarter to quarter, year to year. But they're important things to recognize we don't know and to think about ways we may respond. So the first is around AI. We really don't know exactly how applicable AI will be. Will we have enough data? How quickly will it refresh? What are really the good use cases? Where is there actually an ROI? Where can it be done fast enough to make a difference? And that's the tech. But we also don't necessarily know how humans are going to react to this. There may be things initially that humans aren't happy with and the big brother feel, but then there may come a point where people expect for their needs to be anticipated. And if your needs aren't being anticipated, you're getting a proactive SMS text to tell you to take some action, you would actually consider that to be poor service. The second thing is the provider landscape for outsourcing. We've already seen in this last year the top 25 providers that we track, 2 of them poised for change of ownership. The first was Syntel being acquired by Atos, and that deal is already closed. And then we had Luxoft here in Q4 announced to be, I believe it was Q4, announced to be acquired by DXC Technologies. Both of these were situations where DXC and Atos had more of the incumbent infrastructure business. They wanted to get themselves a little more digital magic, and Luxoft and Syntel are good things to add into that mix. Now, what will happen with the rest of the landscape? Will we see business process and IT services come closer together? Will engineering services and what that means for software and Internet of Things, will those potentially collapse in a more interesting way? Will we have further consolidation of the spaces that are built on traditional value props? So we don't know exactly what will happen here, but there's a lot of possibilities. Third thing, Facebook has basically gone from being a great success story to being a little bit of a villain, and it raises a question of who really owns the data. And although Facebook is the easy poster child for this, this can have a lot of other implications. And when you think about what limits it could place on analytics or AI, it becomes an interesting uncertainty to be thinking about. And in reality, trying to be very, I think, responsible in terms of what's actually being done with information to keep the right balance. And then the final thing is, in some number of developing markets, we're seeing significant shortages of talent. The confidence we saw in the earlier poll that kind of things are generally okay and people are going to meet their targets. That creates tighter labor markets. And as technology changes things, the RPA, the AI, and we believe that there may need to be less human labor. Will that actually happen? How will humans respond to that? And will people be able to change jobs? How will communities change, et cetera? So there's a lot of things there that we don't yet know. And even simple things like to what extent can people really be reskilled and upskilled into next gen things from maybe old gen business models. So let's go to the trend number 2. I'll hand this one back to Michael.
Yeah, so I think the one certainty we all understand is the embracement of the digital platforms and the digital as a tool for productivity and creating value. And I think it's not a question of, are we going to do digital? It's how we're going to do digital. And so what we put together here is what we call our digital capability platform. And so if you think about it, we're going to demonstrate this in layers. The performance layer, where you're focused in on the infrastructure required to provide the scalability and performance. We're going to think about it in terms of the automation layer, where it's really driving process efficiency and lots of hype and actual reality around process automation and RPA, things like that. If we go to the next layer, we're really starting to talk about insights, really how do you take the data and drive decisions. And then finally, we get into the interaction layer, which is really driving that stakeholder experience and really trying to create that to happen. So then we add in the enablers in terms of different ways of interacting and creating the connectivity between the digital layers. So all of these things you can look at and say, I bet every organization out there is doing all of these things. And so what you need to think about when you see a chart like this is how do they all fit together? And so when we kind of look at this and we can say, hey, one way to look at this is look at the different vendors or the different ways you can buy the digital services. And so if I was to give you one example here, you could buy it as a standalone software. So you could buy your friendly, they like to call it their digital workforce or their digital robots. You could buy that as a standalone software, and that's being done in significant quantities and significant uptrend there. But you could also buy that is a service layer. So you could be buying the interaction layer. So you could be looking for a provider that's going to provide all of the interactions, not just a call center, for example, but more than that, providing the interaction layer. Or you could be buying a group of these things, maybe as a BPO solution, looking for a provider that can provide multiple layers at the same time and provide you a robust solution. Or in some cases, you could buy the whole entire package as a BPS platform, BPaaS platform. So the question here isn't are service or enterprises buying this stuff. The question is, where you buy it, who you buy it from, and then ultimately, I think the big question is who owns this process within the enterprise. So where we're doing a lot of work on this in 2019, we're looking at this from many different angles and really on the how-to part of the dialogue. So stay tuned on that. But Eric, talk to us about some of the special kids on the block here.
Great. One thing that I've found very interesting the last couple of years is how much B2B stuff that normally isn't the sexy Silicon Valley type conversation, how it's become interesting to investors. And we've highlighted a couple here that are basically unicorns, which means the valuation of these, still privately held startups is greater than $1 billion US. I think the ones on the left, the idea that analytics has a lot of value, that's probably not too surprising to people. A number of different models there, from services to data sets and solutions. On the far right-hand side, automation, whether those be the RPA tool providers or process mining like Celonis. They've made a great strides, and obviously a hot area of the market. But there's also a whole range of things I just want to highlight kind of in the middle, which we've labeled as cloud, and they're not so much about the cloud, but rather they're really about how the cloud can help humans work differently, which often means you're helping defragment things. 3 examples I highlight here. So basically, JFrog, this helps development happen in a smoother way and sharing of assets. Snowflake is about data management in the cloud and how to help people better manage data. And then TalkDesk is about enterprise contact center in the cloud. So all of these still have humans doing their jobs, but they're defragmenting things, integrating them, and allowing the work itself to change. And the cloud is the critical enabler of that type of approach. Okay, let's go to trend number 3. Michael, back to you on how you see workforces being impacted.
Yeah, so if you remember back, talent was one of the top 3 challenges. And again, I reference back as it's always been there, but it's always been about top talent. Now I want to look at it just in a more holistic standpoint and look at it how it's changing the workforce strategy. So let's go to the next slide where we have a little piece of data. And I would just want to illustrate, Karthik and I are going to illustrate the tale of 2 worlds. And my favorite chart to show how critical this has become in the US, and it's not that different statistics in Europe, but is to use what we call the JOLTS report. And what that is job openings over the available labor supply. So it's unemployed people per job opening. And if you go back to the last recession, there would have been almost 700 people looking for every 100 jobs that were available, so job openings. Today, you can see we're at a very, very different place. And here in the US, we actually only have 90 people looking for every 100 jobs that are available. So think about that. There are 10 jobs, they're not even getting somebody really looking for work there. And I would even suggest that these numbers are even more critical than they would suggest. So there may be 90 people looking for jobs out of those 100 available, but I'm pretty convinced that maybe 40 or 50 don't even really want a job. So maybe the numbers are even more exaggerated than that. But now, I said tale of 2 worlds. Karthik, talk to us about the other side of the equation.
Okay. Again, we have an interesting factor in there, which is, if you look at India's state-run railways, which is a very large employer, 25 million people apply for 90,000 positions. Now, we just need to put this in context, right? Yes, on the face of it, it looks like a dramatic difference. I think the essential point of difference here is that if you were to look at raw supply, look at locations like India and Philippines, for example, there is a significant raw talent. However, and that's really what this thing is looking to illustrate. But having said that, if you were to look at niche skills, like we've been talking about digital a lot in this webinar, there are challenges in finding the adequate number of digital skills at scale, even in evolved locations like India. There is a challenge of both quantity and quality. So yes, there is a tale of 2 worlds, but needs to be put in context of these skill sets. Now, having said that, that brings us to really what we want to convey in this trend is that enterprises need a far more intentional approach to manage the talent skill shortage. If you could move to the next slide, please. So the traditional talent model has really been around, let's go and hire in the market, let's go hire freshers, and that's been working for a while now. But now, given how skills are changing, we see that innovative talent models will become imperative. In other words, companies will not have an option but to adopt these models. And if you break this down, there are three things that we want to talk about. One is evolving existing models. So these are things like scaling, reskilling, upskilling programs, job rotation programs, where many enterprises or GICs, or even for that matter service providers, do some of this at varying levels. But now there is a need to both scale these and make these more institutional. Specialist career paths for niche skills. The traditional model of career pathing has been grow by managing more people. Right? So you manage 10, 100,000, but for niche skills, the career pathing needs to be very different. Sponsoring certifications and courses. So these are near-term needs. Most companies have these in some form or shape, but there is a need to evolve and institutionalize these. The second category is really how do you engage the ecosystem in a more innovative manner. So things like hackathons, gamification. This could be used in learning and development, right, to change the mode of learning and development. Hiring from alternative and adjacent industries. If you were to take the banking industry, for example, banks typically tend to have a view that says, okay, let's hire from peer banks because we want people with the right domain experience, functional experience, technology experience. But when such skills are in short supply, there is a need to think more creatively. Right? So we've seen banks hire from ad agencies, for example, when you look at some of these digital marketing skill sets. On-demand customized learnings, right? So use of MOOCs, e-learning, which are a departure from the traditional ways of using learning and development. When we say partnerships with educational institutions here, we don't mean just campus programs to hire, but how can companies intentionally partner with educational institutions to develop courses which will help in the long-term talent acquisition pipeline. The third category is really about rethinking the workforce. So as enterprises need to take a more integrated view of global workforce planning. So what does that really mean? So think about where is it that they want to use permanent employees, GICs, where is it that like service providers or even independent contractors, freelancers, how do these play a role? Again, these are not new concepts in themselves, but as the whole talent model changes, the nature of skills and demand changes, there is a need to rethink these. The traditional models will not work for the future. Then there's this concept of virtual workforce. How can work from home be scaled more effectively? How can companies leverage crowdsourcing in different pockets? And underneath all of this, there is how do you embed digital and innovation in the culture of an organization? So by this, what we mean is it is not something that is just a goal that the senior management talks about, but how can this be made embedded in the ethos of the organization? So net companies will need to both evolve existing models, better partner with the ecosystem, and rethink how they look at workforce planning. Okay. Now, which brings us to the fourth trend. We talked about the tale of two worlds and how, at least on a relative basis, right, there is the talent situation in places like an India or a Philippines or a Poland, where at least there is raw potential available in terms of skills, lends them to take on broader roles. So what we see now, what we expect will happen is, given the talent shortages in developed markets like the US, we're going to see more ownership in GICs, and GICs being used to build net new capabilities for the organization, as opposed to just transitioning work that was done elsewhere. Now, if you were to break this down, there are three types of ownership that we see in GICs. The first is delivery ownership. So what does this really mean? The GIC is owning the execution of a process. This could mean a reconciliation process or a project. Now, this is a fairly established model in the GICs, and there are multiple functions and applications or types of services where the GIC penetration is in excess of 50%. So what does that mean? More than 50% of the global workforce is in the GIC. So that's purely delivery ownership. We see that moving to the next level, which is capability ownership. So which ties into the skills shortage point that I spoke about, and which Michael touched upon as well. So GIC will increasingly start owning critical capabilities. So by that we mean not just delivery, but thinking about process standards, thinking about really building net new capabilities, which may or may not exist in different parts of the group. So a great example of how this is manifested so far is in RPA, where the GICs have served both to initiate RPA within the construct of work being done in the GICs, but that has also served as a blueprint for the broader enterprise. So the GIC is helping develop templates, the expertise to help roll out RPA for the broader organization. Another example here is analytics. Now, where we see the future is we will see more global process and technology owners based in the GIC. So what we mean here is, say, global technology owners. It could be CIOs, for example, of certain applications. So these could be applications or lines of businesses where the combination of delivery ownership and capability ownership already exists. So it also naturally makes sense for the global process owner or the technology owner to be based in the GIC. And when we say GIC, it doesn't have to be India, it could be anywhere in the world. But really it's a combination of where the capability resides, and this is where we see the nerve center really shifting from a global process technology owner standpoint. Another example we see here in the GIC, where we have the global head of risk and analytics being based in the GIC. Now, will this happen for all processes, all technologies, all BUs? Absolutely not. But directionally, we will start to have more global ownership in the GICs, wherein we will see global leaders for the enterprise being based out of the GIC. Now, before we move on to the next trend, we've talked about talent shortages. What does it mean from a talent model perspective? We've talked about what it means from a GIC perspective. So I'm going to ask Eric to wrap it all together in terms of how he sees the future global sourcing integrated strategy for enterprises.
Great. So the point Karthik is making, we'll talk about in the next slide, is organizations have had strategies for how to deal with their technologies, their talent, and their sourcing models. And we believe in a digital world where things move closer together and are more intimate with each other, whether those be activities, data, technologies, people are going to need to not only revisit a few key things, but they're going to be, the answers are going to be different, and some of the questions they need to ask will be different. So as we're seeing here on slide 36, there's a set of requirements when you're thinking about, okay, how to actually solution for an individual service. So you want to think about what's the technology being used, you think about the talents, what skills are required, what volumes, those sort of things. And then what sourcing model might you want to use for that? Is it an internal model like the GICs that Karthik was just talking about, or is it an outsourced model, or some other, maybe a contractor model or something? What we think is increasingly important is that there are some integrative thought processes for the enterprise that they need to be asking about how they want to shape how these requirements end up getting solutioned and optimized. And although people have ways in the past where they thought about the portfolio design of the sourcing options and their workforce planning, we think these take on new flavors, and some new things need to be considered, and the answers will be different than what they would have been, say, 10 years ago. So looking first at portfolio design, the role of incumbents versus disruptors, people will probably try to think about that a bit differently, and where things may head. Also, when you don't know what the standards are going to be, you in some ways need to make sure you're selecting the technologies and the providers that are going to allow you to continue to adjust. Said differently, you probably want to make sure you're going to ride the horses that are likely to be winners, or at least be able to switch horses quickly. If we think about workforce planning, the sort of things to consider here, how confident are you actually in the demand forecast? How much certainty or uncertainty is there around that? What would happen if the required labor actually decelerated even more due to technology? Or what would happen if it didn't? Are you betting on it, but it may not happen? What types of new development and training may need to consider, and how might that impact how you can repurpose people? Can there be more training on cognitive skills versus just hard technical skills? And then finally, things like how much can we achieve by driving labor productivity? We haven't spent as an industry as much time on this in sort of open conversation, but you can see some pretty big impacts in certain types of work by designing for productivity, measuring it, incenting it, gamifying it. It's not uncommon when we talk to organizations that are having productivity initiatives that they may get 15 to 30% just in the human labor part of it, ignoring the technology contributions as well. So with that, let me hand it back to Michael. And Michael, I think you're going to help facilitate some Q&A here from the things that came in during the webinar.
Yeah, and Eric, I would go back to that, your comment about the, one of the best answers to that talent shortage is going to be the productivity we can get from the digital investments. So a lot of times initially there was a lot of scare, hey, the digital workforce is coming here to replace the existing workforce. And I think the reality is it's not going to replace the existing workforce, but hopefully it gives enough productivity improvements so that we can continue to drive growth as an economic engine at the same time. So I hopefully the digital workforce arrives just in time. All right, let me ask a question here, and I got one for you, Karthik, specifically to, let me pull it back up here. Is the increase in number of outsourcing deals reflective of new buyers in the market as well, or the medium to smaller ones as well in new markets? So comment about where the outsourcing deals is, how's it reflected in new buyers?
Yeah, so new buyers form a significant contributor to the growth, right? If you were to look at the share as a ratio of the total deals, obviously, there will not be a significant share. But if you look at incremental deals, the new buyers played an important role. Not so much from new markets though, because we saw growth coming from the traditional developed markets like the US, for example. Of course, there was growth in the APAC region as well. So it is not so much about newer markets, but definitely about newer buyers. Having said that, the existing buyers, but by that I mean buyers that had outsourced before, also entered into new outsourcing deals in 2018 on the back of increased confidence, pent-up demand, the points that I talked about earlier in the webinar.
So Karthik, I know your team's working on helping clients set up new GICs, and you referenced the do-it-yourselfers. Comment on some of the, hey, there was a big wave of big companies doing things earlier, or over the last decade, let's say, but you're seeing a new wave coming. Talk about that.
Yeah, I think this is pretty fascinating because we look at GICs at different stages of maturity, right? So you would first start proving the concept, and the typical evolution path would then be to build scale, build a more reliable service delivery engine, and then move on to build value-added capabilities. But a lot of the new GICs, they're starting at the higher end of the maturity cycle right away, right? Because they've been set up with a clear vision to drive some part of the enterprise's digital agenda. So it's not like saying, let's start with transactional work, let's build that scale, then move into complex work. But the entry point itself is a lot more bold, and that is a virtue of confidence in a more established industry that we spoke about. So in the examples that I was citing, we help the clients truly integrate the GIC into the parent organization right from day one. So how do you think about ownership? How do you think about the governance model to make it successful? And when that is done well, the whole concept of economies of scale goes out of the window. As I said, you can make it economically successful even with a scale of 50 to 100 FTEs.
Okay. All right, thank you. I got another question here around is the numbers that I was showing in one of the charts that talked about the only 90 people looking for jobs in the U.S. for every 100 job openings, and I made the reference to also that probably not even all 90 are even enthusiastically looking. They're just looking to keep compliant with their either the government's requirements for unemployment or maybe their spouses or mom's ability to push them out into the job market. But the question here was, is this just about the IT job market? And I would say, no, this is about the broad market. And I would say that the IT job market's going to be even tighter. So I bet there's probably half that number looking for IT jobs, but we'll look see if we can get you some answers on that. All right, I think why don't we end it here? I wanted to kind of go to the next slide. I want to show you some other resources that are available. So you can certainly check out our blog for the latest perspectives. So the www.everestgroup.com blog. And then we also, if you look at our research pieces on the next slide, there are a number of related content that you can certainly get access to, and our clients would be able to drill immediately into those. But we'd be happy to help you with that. And with that, I think we conclude the webinar here. So.
Perfect. Thank you again to Michael, Eric, and Karthik. And thank you everyone for attending today's webinar. Again, you will receive a follow-up email within 24 to 48 hours with a link to download the presentation slides along with an on-demand playback of today's live session. On behalf of the Everest Group and our presenters, thank you for joining us today and have a great rest of your day.